Today we will be looking at Academy Sports Outdoors, ticker ASO. The last close is 60, market cap 4 mil. Before I start this video, I just want to go over and give you guys a layout of how the video is going to go. So we'll do a quick little overview on this page, and then we'll look at the income statement, the balance sheet, and the cash flow briefly. And then I'm going to run a bunch of formulas. I'll look at the leverage, the liquidity, the management, and we'll just basically crunch a bunch of numbers. The intrinsic value, run a DuPont formula, and I'm going to try as I go. I'm going to try to explain what I'm doing, so that even if you are experienced or a new, like a new investor, then maybe everybody can learn something from it. So it is a retail company. If you read this, you're going to find out that they sell a bunch of items basically, and it reminds me of Dick's Sporting Goods. So Dick's Sporting Goods would be a big competitor here. As of June 14th, 2022, operated 260 retail locations. I don't really care about the key, just for the sake that I've already done research on the company, and I know that the IPO, the initial public offering, was released in 2020. And so they've had an increase year after year. And these are big numbers since the IPO. I guess you could go over here and look at the PE and see it's at 7.6. So, I mean, I would take it with a grain of salt. If it's, I mean, you could say this number's good or bad, but you honestly really don't know. The return on assets, looking at 2020, 3, 13, 4, increase, 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 increase. Like, these are insane numbers right here in 2022. So let's look at this real quick. So the first thing I do is come to the balance sheet on every company that I assess, is look at the total current assets, and I compare it with the total current liabilities. And basically what this is just going to show you is if the company is able to meet short-term obligations. And what I mean by that is, so accounts receivable, accounts payable, you could look at cash as well, is just things that are going to be received or paid within 30 days or so. So you want to see more current assets compared to current liabilities. And we'll crunch this later in the video into ratios. The next thing I noticed about this company, and this is what confused me when I was initially looking at the company in 2019. You got a 496 here in PP&E, and look at this jump. So what I'm thinking the company did in 2020, they released the IPO, they got a bunch of owner equity within the company, and they purchased assets. And they've just been doing a good job getting returns on the assets and managing the company. We can go down here to long-term debt. Well, first let's look at the total assets. So if you look at the total assets, increased year after year, which is good to see. So it's growing, but the total current liabilities, so I would like to see this a bit lower. I don't like it that it's 4 to 3. So I would like to see this a little bit lower. So I jumped over here to long-term debt. The long-term debt, they have been decreasing year after year, which is good to see. And you don't want to see long-term debt completely wiped out. I mean, it's good to see that it's decreasing, and I would like to see the total liabilities decreased a lot more compared to the 4. But that is what grows a company. So what I'm predicting in the future years, maybe 2022, maybe 23 or 24. They might keep lowering in 23 to get the liabilities down some more. It looks like that is their goal. But in 2024, once they've got it lowered enough to their liking, I would probably see them go more into a jump up in the liabilities. We can go down here to retained earnings. In retained earnings, if you don't know what retained earnings is, it's just earnings from owners that are retained within the business. So in 2020, IPO releasing, the next year they retained earnings and we got an increase. So it looks like the company is bound to continue growing, which is good to see. Let's go over here to income statement, and I'm just skimming this really quick because I've already done this. Um, but I just want to go over of everything that I've done so far. Cost of goods sold, it's just increased year after year. The gross profit increased year after year. Operating year after year, and these right here, this is really good to see. But later in the video, like, we'll compare everything to the on a vertical analyst. We'll compare everything to the revenue to see how it all lays out. Net income 120 to 671. So everything's looking great. Increase in EPS since the IPO. What I like to look at is diluted, and that takes everything in. And it's still great numbers. Cash flow, which also checks out. Cash from operations is positive. So when I look at a cash flow statement, and I don't know how most people look at it, is I always want to see cash from operations positive. I always want to see cash from investing negative, and I want to see cash from financing negative year after year. And then so if you take this, subtract this, you're looking at around 100 um of cash flow. So the way that I look at it is positive, negative, negative, positive. Unfortunately, Quick FS doesn't show the um positive cash flow down here, but everything checks out. So it basically just tells me that the company is just in getting cash from operations, which is great. They're not having to dump financing to cover bad operations. So everything is working properly within the company for growth. So now what we're going to do is I'm just going to run a bunch of formulas, and we're just going to go over each one step by step. All right, the first ratio we're going to look at is the measure of liquidity. 2021 current assets over current liabilities, and this is what I was talking about earlier, is the short-term obligations that the company can make. And it looks like if you crunch these numbers, you get $1.21 of assets to $1 of liabilities. So which isn't good, which isn't great. In 2022, they did jump from to $1.52 of assets to $1 of liabilities, which is good to see. Asset quick ratio. Now this is a little bit different. So basically how this works is you take things that are cash or will be cash very soon, and it goes for the same as the liabilities. So the accounts payable, accounts receivable, these are things that will be cash, or the company will have to pay very soon. And then of course you can take the cash. And if you take 378 plus 17, you come up with 395, and you divide that by 791. And what this means is that 47 cents of assets to $1 of liability. Not good. In 2022, they did get an increase of 68 cents of assets to $1 of liabilities. We did see an increase here, which is positive. But Take this number with a grain of salt, I would say. Um, because we don't know everything with the company, right? So one thing that we're leaving out here is um inventory. For example, I'm just going to give you an example so you can understand a little bit of how this goes. So a company, let's say the company purchases a bunch of inventory as a liability. But at the same time, we don't know how much of the markup on that inventory that the company is receiving to meet short-term obligations is what I'm saying. So just so when I like to run this number just for the sake that I want to see an increase within the asset quick ratio. Measure of the leverage. Now this takes everything. Yeah, total liabilities divided by total assets comes to 75 cents of liabilities on $1 of assets. 2022, we did get to see that they did lower liabilities, and like I was saying before, when we were looking at the long-term debt, they were lowering year after year. So it does seem like this is a goal of theirs, and it is showing right here when we run these ratios. The measure of the management. Now, this is going to be, I guess you could say, a little bit more advanced. The cost of goods sold right here. You find you find this on the income statement. So we got 3,955. Here we're taking the inventory average. This is on the balance sheet. So if we're looking at 2020 year, the year 2021, you want to go a year before. So in 2020 plus the inventory in 2021, you add these two numbers up to get the average and divide by 2, and it comes out to 1,045. We get 3.78. And what this means is that about 3.78 times the company purchased inventory and sold cost of goods. But we can take this a step further. So there's 365 days within the year. Divided by the 3.78 comes out to 96 days. And what this tells us is it takes the company about 96 days to sell a product. So I did go ahead and compare it with Dick's Sporting Good, and theirs was 116 days to sell the product. Now, assuming, actually, I probably know that Dick's Sporting Goods will have more retail locations um, than ASO. So that will definitely be a factor as well on the days to sell a product, because we don't know how the management is within certain retail locations, and they could be slower in places due to location management and other things. Um, 2022, we did see a decrease. It only took 82 days to sell the product. Dick's also got a decrease to 102 days. Here's a DuPont formula. The one reason I like to run this is it shows a lot more. So, but if you take each one of these ratios and put them together, multiply them together, you come out with an ROE. So we can break down every single one of these to get a better understanding of how the company is performing. So looking at the net income over sales, we got 0.054. And this, what this means is about 5.4 cents of net profit on $1 of sales. Or you could say 5.4% return on sales. Sales revenue over total assets, we got $1.29 of sales on every dollar of assets. 3.94. Now I don't like this number. I don't like it a bit. But what this is telling us is total assets over equity. 3.94 of total assets for every $1 of assets provided by owners. or you could say 3.94 total assets. Owners provided $1 and creditors provided $2.94. So I would like to see this number lowered quite a bit. In 2022, we got an increase here, we got an increase here, and they did lower it here. So the ROE 2021 is 27%, and 2022 41%, which is good to see. Right here I did a vertical analyst. And so basically how this works is you just divide into revenue. Cost of goods sold divided into revenue comes out to 69. Gross profit divided into revenue comes out to 30. Revenue divided by revenue, 100%, of course. So let's look at this. The cost of goods sold 2021 was 69. In 2022, we got a decrease. Now we're comparing this to revenue. But why did we get a decrease? We don't know for sure. We're going to have to make a couple assumptions that they either marked their inventory up, they lowered their inventory, or they kept it the same. And if you look at the gross profit, we did get an increase, even though that the cost of goods sold did lower. So what I'm going to make the assumption that they marked it up due to the inflation that is going on in today's world. Operating profit. And right here, I'm about to skip something. So this was very interesting to me, is that even though they got an increase in gross profit, they lowered their operating expenses. Now within operating expenses, they got to pay like um the administration, employees, and so on. So stuff like that. So they increased gross profit, but they lowered the operating expenses, which is great to see. Great to see. And we got an increase on operating profit. Uh, Net income was also an increase, so which is good to see. The PE. So I ran the intrinsic value on the PE. I'm not going to go over these numbers over here. It came out to 54. What was the last close? It was 59, almost 60 or something. So it is overvalued a bit. Intrinsic value on the ROE was 32. Now keep in mind that whenever you're running these type of models, it is just estimates. It is not 100% accurate by any means. It just gives you an idea of where possibly you should buy in or not buy in at all. So ROE's 32. Cash flow valuation was 55. So what this is telling us is a little overvalued, but it doesn't mean that you can't invest into the company now. And with it being that close, like I would be more concerned with the intrinsic value if it was like 70 or $80 a share. This is just a couple of dollars off, so which isn't bad at all. And if you honestly believe that the company is going to keep growing at this rate year after year, then it's an excellent buying opportunity at the moment. I will say this, and this is the thing that concerns me the most. The industry that AOS is in is highly competitive. So you're never going to see gross margins over 50%. I would say they're going to be consistently around the range of 20 to 30%. Now, if you find a unique business where there's barely any competitors, then you're going to have way higher gross margins across the board. The only way that I actually see that the company maintains these numbers is through growth, opening new retail stores year after year, to get the return on these. But it looks like within the company that the management is managing the company extremely well, extremely tightly. So that's why we're getting these type of numbers. Personally, I'm going to wait on buying AOS ASO just for the sake that I'm not 100% positive that they will keep at this rate. I could be completely wrong. This isn't financial advice by any means, but I'm just giving you guys my own personal opinion. I hope this video was helpful, and if you got any questions, leave comments below and I'll try to answer them. Thanks for watching.